Developing a simple trading plan. Introduction. Welcome to Developing a Simple Trading Plan. A trading plan is essential for success, acting as a roadmap that guides your decisions and keeps your emotions in check. Without a plan, trading can quickly become impulsive and inconsistent. Today, we'll cover the key components of a trading plan and how to refine it over time. By the end of this session, you'll have a blueprint to start building a structured and disciplined trading strategy. Section 1. Why you need a trading plan. Purpose of a trading plan. A trading plan removes emotional decision-making and enforces discipline. It sets clear entry and exit rules, risk management, and overall trading goals. Example: instead of guessing when to exit, your plan specifies profit targets and stop-loss levels. Consistency over randomness. A structured plan ensures consistent decision-making across all trades. Example: if you follow a strategy with a 60% win rate, applying it consistently ensures long-term profitability. Accountability and learning. By following a plan, you can analyze what works and what doesn't, leading to improvements over time. Section 2. Components of a simple trading plan. Define your trading goals. Set realistic and measurable goals. Example: earn 5% monthly growth or risk no more than 2% per trade. Identify your trading style. Choose a style that fits your schedule and personality. Day trading, multiple trades in a day. Swing trading, holding trades for days or weeks. Position trading, long-term investments. Select markets and instruments. Focus on stocks, Forex, crypto, or commodities, depending on your interests and knowledge. Example: trade Forex pairs like E or USD, or focus on tech stocks. Develop entry and exit rules. Entry signals. Use technical indicators like moving averages, RSI or MACD, or fundamental events. Exit rules. Predefine profit targets and stop-loss levels. Example: enter when price crosses the 50-day moving average, exit when RSI reaches 70. Risk management. Never risk more than 1 to 2% of your account per trade. Use stop-loss orders to protect capital. Ensure each trade follows a 1-2 risk-reward ratio. Section 3. Building the plan. Step by step. Set up a demo account. Use a demo account to practice your plan without real money. Example: if testing a